If you're new to investing, understanding the stock market can feel overwhelming. But don't worry. Today, we're breaking down 10 essential terms every beginning investor needs to know. By the end of this video, you'll have a solid foundation to navigate the market with confidence. Number 1. Stock. This represents ownership in a company. When you buy a share of stock, you own a small piece of that company and may benefit from its success. Stocks are typically traded on exchanges like the New York Stock Exchange or the Nasdaq. Companies issue stocks to raise capital, and in return, investors can earn profits through capital appreciation or dividends. Understanding stocks is crucial, as they form the backbone of investing. Number 2. Share. A share is a unit of ownership in a stock. When you own shares of a company, you are entitled to a portion of its profits, typically distributed as dividends. The price of a share fluctuates based on supply and demand, company performance, and broader market conditions. Buying shares is the most direct way to invest in the stock market. 3. Stock exchange. A stock exchange is a marketplace where stocks are bought and sold. Major exchanges include the NYSE, Nasdaq, and the London Stock Exchange. Exchanges provide liquidity, allowing investors to easily buy or sell shares. They also ensure transparency and regulatory oversight to maintain market integrity. 4. Ticker symbol. A ticker symbol is a unique series of letters assigned to a publicly traded company. For example, Apple trades under the ticker AAPL. Ticker symbols make it easy to identify stocks on exchanges and trading platforms. Number 5. Market capitalization. Market capitalization, or market cap, refers to the total value of a company's outstanding shares. It's calculated by multiplying the share price by the total number of shares. Companies are classified as small cap, mid cap, or large cap based on their market cap, which helps investors gauge their size and potential risk. 6. Dividend. A dividend is a portion of a company's profits paid out to shareholders, usually on a quarterly basis. Companies that consistently pay dividends are often financially stable and therefore attractive to long-term investors. However, not all stocks pay dividends, especially growth-focused companies that reinvest profits. 7. Bull markets and bear markets. A bull market is when stock prices are rising, indicating economic growth and investor confidence. A bear market, on the other hand, occurs when stock prices fall 20% or more over a sustained period, often signaling economic downturns. Understanding these market trends helps investors make informed and timely decisions regarding portfolio alignment. Number 8. Bid and ask price. The bid price is the highest amount a buyer is willing to pay for a stock, while the ask price is the lowest amount a seller is willing to accept. The difference between these prices is called the bid-ask spread, which can impact the cost of trading. 9. PE ratio, or price-to-earnings ratio, compares a company's stock price to its earnings per share, or EPS. A high PE ratio may indicate that a stock is overvalued, while a low PE ratio could suggest it's undervalued. Investors use the PE ratio to assess a stock's valuation and growth potential. Number 10. Exchange-traded fund, or ETF, is a type of investment fund that holds a diversified portfolio of stocks, bonds, or other assets. ETFs trade like stocks on exchanges, making them a convenient way for investors to gain exposure to multiple assets while minimizing risk. Now that we've covered these essential stock market terms, you're one step closer to becoming a confident investor. If you found this helpful, don't forget to like, subscribe, and hit the bell icon for more beginner-friendly investing content.